the past is only going to tell you so much. You're going to have to take a view on the future, which is pretty tough. And then sooner or later, it'll disappoint. And you'll say, does that mean all bets are off? Is this thing looking like a catastrophe? If it doesn't, well, you've got to stick with it, I would say, and buy some more. If you feel that the long term is still there, you've got to hold your nerve. That becomes harder. First of all, have the mentality as an investor rather than just trade. So if you're an investor, you need to be prepared for short-term losses as well as gains. That's the nature of equity markets.
Hello and welcome to the Fundamental Asset Podcast with fund manager Chris Boxall. Today's episode is less about individual companies and more about the wider investing concerns around UK PLC and what could be done to help the UK become more attractive for individual investors and more attractive for companies to list here. Chris covers a wide range of concerns and solutions that could help improve conditions for investors and the companies that list here. Let's get started. Hello, Chris. Welcome.
Hi, Lee. Hello.
Hello. Welcome back to the Fundamental Asset Podcast. I'm going to open with a pretty interesting question. So Morgan Stanley is on the side that stating that UK equities and bonds are arguably the cheapest in the world, whereas Richard Buxton, fund manager of Jupiter, investing for 40 years managing UK equities, he states that the UK equity market is in a very sorry state. So who's right then?
I think both are right, but I think both needs to be put in context, probably. I think the UK equity market is in a bit of a very sorry state. That's reflected in its lackluster performance over the past 5-10 years. And what do UK investors want out of the UK equity market? Those that have been there have gone nowhere. They've received some pretty hefty dividends from a lot of companies, but in terms of share price return, it's been really diabolical compared to the main US market and generally global markets. Even our closer neighbors in Europe, some of the European markets, French market has done better. And the UK market has been really poor. It's questionable why so many UK investors are fixated by only holding UK shares, and they should look further afield. These are companies they're familiar with, more familiar than with many UK companies. So I see no reason why they shouldn't be investing in them. Is it cheap? I think this is an interesting one. Yeah, it's cheap on traditional valuation metrics. And you've got some good businesses that are trading, and I'm talking large companies now, not necessarily the smaller ones that we often talk about here, but some large FTSE 100 companies are cheap on traditional PE multiple metrics, and the dividend yields are pretty high. But I think you've got to look at why they're cheap and why the dividend yields are so high. Have they been paying out too much in dividends rather than reinvesting the cash that they've generated, and prodigious amounts of cash in some cases over the years? And this isn't a stock I own and we haven't owned in our portfolios, but we had a look at British American tobacco. No, tobacco is not the flavor of the month or the decade, really. So it's not a stock that many people like, but it's still it's a pretty big UK company. It's on the FTSE 100. It's 60 odd billion market cap. It's a huge business and it has a massive dividend. But and you look at its cash flows over recent years and they're massive. This business generates circa 10 billion of cash each year. Wow. It's huge.
Yeah,
that's massive. But most of its cash it uses to pay out in dividends or share buybacks. Its share price has effectively gone nowhere, and the only return investors in it have made, and that's been quite generous, is via its dividend. The yield's about 9% at the moment, dividend yield of 9%, with the share price going nowhere.
Big dividend, that isn't 9%.
It's huge. But a business generating 10 billion of cash, shares have gone nowhere. It's focused in a sector that's always under pressure, under threat. And it's not alone. It's one example. Imperial Brands is another UK listed company, and the mining stocks, their energy stocks. These are pretty boring companies that are struggling to attract interest from the investment community, whose outlooks look questionable. Yet they are big generators of cash. I would suggest that they need to look at how they're deploying their cash. Rather than paying out the divvies, perhaps the investors could have directed them to think, perhaps you should be thinking about greater investment. British American Tobacco's capitalized development investment expenditure is peanuts. It's about 6% of cash flow, operating cash flow, which isn't a lot. Could that be used, much as other conglomerates do, in other ways? Should it only be wedded to tobacco? Should it be looking at other areas, higher return areas, growth areas in which to invest its prodigious cash flow? This isn't new.
Mm.
Bats years ago had involved interest in insurance companies and all a host of other interests. The conglomerate isn't necessarily a bad thing. Managed conglomerates led at the top with a very disciplined capital allocation process, it can be a brilliant business. I mean, you look at the biggest of the lot in Berkshire Hathaway with Warren Buffett and Charlie Munger and people in pulling the strings. It's all about capital allocation. They take a cash flow from insurance and redeploy it in a host of other areas. Could Bats and Imperial Tobacco and lots of other UK companies start thinking more creatively on those lines to help feed growth and innovation as well? I think that's what's got to be looked at. It's all very well complaining that they're boring businesses, but they're still pretty good boring businesses that generate a lot of profits and a lot of cash.
Would the government be better suited, perhaps, guiding those companies to deploy their cash to better use than people's private pension?
I think that's a really interesting point. The government, yeah, I think that's absolutely spot on. There's available cash there. They could be, and we'll give them incentives to do it as well. Give them some
Incentives.
corporate tax breaks. As I understand it, or my knowledge of tax breaks, most of them are at the individual level. You have EIS, you have VCT breaks, and most of those benefit the individual investor. IHT breaks through business relief as well. Should there be more corporate investing tax breaks? As you say, if you look into the FTSE 100, you've got a lot of very elderly businesses that are very well run and very profitable that could be doing more or better, could be doing better with their capital allocation in mind. And I think with the bat, it's highlighted by Danaher, US listed Danaher's acquisition of Abcam. Abcam was AIM's largest company until end of last year, 2022, and it moved its listing from AIM to the US stock market. It's now, less than a year later, being acquired by Danaher, a US corporation, which has been incredibly dynamic and growth oriented and has redeployed, I think, double in percentage terms the amount that in investment than the likes of Bats has over the years. And Danaher has a load of interests. I mean, it's involved in life sciences, biotech, it's all over the place. It's got lots of fingers in lots of pies, but it's clearly a very shrewd allocator of capital and available operating cash flow. Now it's buying a business, an antibody business in Abcam.
Yeah.
Which is really sad. I mean, Abcam could have grown, first of all, in the UK market, let alone the US, but now it's going to be swallowed up.
Yeah, it's a shame that we're losing companies like that, especially around the life sciences. You would hope that the UK government would have seen that as a great growth opportunity for the UK market as a whole to really benefit from the growth of these life sciences, but then to watch one relocate its listing to the US.
Oh, yeah. It was a really exciting AIM company as well.
Yeah.
Clearly, the founder wasn't very happy. The founder's no longer involved, came on an executive level, but he wasn't very happy and he tried to sort of stir things up a bit, but that's now been chucked out and it looks like they're going to be acquired.
Yeah. So you mentioned that Berkshire Hathaway, they've used their immense wealth to redirect capital and create further share value for their shareholders.
Notoriously, Berkshire doesn't pay a dividend. So it's used all its cash. It's insurance flow to acquire other businesses. It's got huge stakes in Apple, American Express, Coca-Cola. Those are its equity investments, but it's also bought entire businesses in manufacturing. Years ago, way back, it bought See's Candy, a business that did boxed chocolates around the US.
Do you think that British Tobacco and the other companies you mentioned, the mining conglomerates, do you think they're serving their primary shareholders, which are probably pension funds that are looking for that stable dividend?
Yeah, I do. As I say, they need to have a discussion with the pension funds. Say, look, guys, supposing you don't pay out so much, how about if we have a restructure things? How would you feel? So I just think there needs to be a discussion, sort of a general sort of top-down level. Because you look in, there are some really good businesses, and I think it comes down to often poor capital allocation. That applies to small companies as well. Some of them make acquisitions and they don't think through properly.
Yeah. Well, you mentioned Abcam leaving AIM, and that seems to be a trend that seems to have been happening for the last 5 years. The investment bank PL Hunt has done a study, and they found that in the last 5 years, AIM has lost 97 companies, which represents a 12% decrease. And obviously, with the index approaching pandemic lows, how do you interpret this?
I think the changing nature of AIM, it's very different to what it was a decade or so ago. There you had the number of companies on AIM falling, many due to failures. Nowadays, you're having fewer failures and more takeovers and also a lack of listings. And AIM is a market supposedly for growth companies, and you need this flow of new listings. And there's little to encourage companies to list. Many of those that did list, notably during the pandemic, were too opportunistic at the time. I mean, there were a lot of online retail things whose business models were relatively unproven. But you do need to, in some way, encourage newcomers onto AIM. For my mind, you need to make the listing process a bit easier, less onerous. All right, people will say, well, you're going to have questionable things, businesses there, but you can control things in other ways. And you need to make it less costly. I mean, it's very costly to list a business for what amounts often to a lot of boilerplate language in terms of legalities and a whacking great commission to brokers as well, should they be successful. So the costs need to come down. If I was a founder wanting to list my business and was going to be told it's going to cost me numerous millions of pounds, I'd probably take a deep breath, first of all. If they're bigger, that's a drop in the ocean. But I think the whole process needs to be more streamlined and made cheaper.
How much do you think that the 25% corporation tax rate on these smaller companies recently?
I think it's going to start having more of an impact. I do agree it's going to start hitting the profitable ones, unfortunately, the better ones. I think the greater impact at the moment is perception and sentiment. Everybody thinks you don't want to be near smaller companies in a rising interest rate, inflationary, questionable recessionary environment. But in our experience, founder-led smaller companies are often a very good place to be. They adapt pretty quickly. Founders with a significant stakes, last thing you want to do is see their stake fall.
Yeah.
And they do adapt, and they adapt much quicker than a much bigger corporation with its multiple management tiers and more, complex structure. Some of the share prices of some are being hit unfairly because of this. And I think corporation tax is one issue, but I think there are many others that are contributing.
Yeah. When someone's looking to analyze these stocks, they're looking for these types of companies that are still going to do well over the next 5 to 10 years. What would you say to them that can help make them a better analyst?
From a perspective of investing, we're investors, not traders. So let's ignore the trading. We don't,
Yes.
we're not mystical chartists and things like that, looking at all sorts of weird and wonderful shapes in graphs. There is a grounds for looking at them occasionally, but we're talking from an investment perspective. I think you have to you go back to basics, a good degree of common sense. In the current market, you need patience. Don't expect things to turn immediately. Some of the best stocks we've ever bought have dropped materially and subsequently risen a lot. So it's taken patience. In fact, one of our biggest holdings, a veterinary group, CVS Group. We've held CVS Group since IPO. I don't know how many years ago now. Close to 15 years. CVS Group, the veterinary group. That was a terrible performer in the first few weeks, first few months of IPO. I think it's dropped about 20%. You look at that stock now, it's a £1 billion plus company. So that's taken patience and occasionally nerves of steel when it's disappointed. So patience is key. Going back to a previous comment, need to understand the business, how it makes money, what it does. And you can find that out on the company's website. If it's an AIM company, they all have to have an admission document. Great reading. The admission document is full of loads of interesting information about the background of the business, the management. Clearly, if it's been on the market a while, the admission document is going to be out of date. But anything listed in the last 5 years or so, look at the admission document. And it's all in AIM company, it's all under AIM Rule 26. Companies themselves do presentations. Look at those. They're an easier read. Generally, they present things in a very positive light, so it should be taken with a pinch of salt. But a lot of people say, read the financial statements. Well, nowadays, they run for hundreds of pages. A lot of people look at those and think, crikey, this depresses me. And they probably only look at the pretty pictures again and not the information they should be reading.
Yeah.
So I would say that as a first step, look at the results through the regulatory news service, through the London Stock Exchange. So preliminary results there are the numbers are the final numbers. It's preliminary. But they haven't got all the huge amount of waffle and narrative that the annual report has. So it gives a good insight, it gives a little description of what's about the business about, then it gives all the key numbers for the year or 6 months. I think those are good places to go. There are books, but there's no substitute for reading accounts to see things at first hand and to then work things out for yourself a little bit and compare one year to the other. There are so many adjustments that we fall onto the cash flow statement really quicker than anything. The cash flow statement, it's harder to hide things. Yes, you have some seasonality in some people that are cut off around Christmas, maybe a bit more cash than those that might be before, if you're especially in the retail space. But the cash flow statement irons out all the adjustments that management are enthusiastically putting into the income statement. So you can get a better picture, because at the end of the day, a business is only so good as the cash it generates and the free cash it generates. So it's pretty basic to see that. And if a company's cash flow is all over the place or going down, it doesn't take a genius to realize that things aren't quite right.
Yeah.
Particularly, so you've got operating cash flow and free cash flow. So I would urge people to leap through all the adjustments, descend on the cash flow, and you can see all the lines and see what's happening. And certain things adjusting the cash flow, you raise more questions. It's quite interesting to see feeding backwards a little bit.
Brilliant. So you found a company that's got good cash flow, share price is depressed because of what we're seeing going on in the markets at the moment. How do you hold on to it for as long as 15
Well,
years?
then you've got to make two assessments. You've got the history that those accounts presented, but you've got to then look at the future, where you think things are going. And do you have any insight? You probably don't, unless you're in the sector. Crikey, you're not going to have insight and everything. Whether it's a veterinary service business might be easier to understand than some, but you've got to have some vision of where things are going to start moving, how this business is going to grow, or whether it's going to stagnate. We spoke about a tobacco company, British American Tobacco. Clearly, that's a sector that is always under pressure and has been forever and a day, more so nowadays. And you can see from its numbers, it's struggling to grow, but it's generating a lot of cash. When does the music stop? Could things become critical? A veterinary services business, there is growth potential. There's a growing pet population in the UK, and over COVID, there are a lot of positives. Is that going to continue? So you need to make an assessment and see how it's deploying its cash to greatest effect. It's two things. The past is only going to tell you so much. You're going to have to take a view on the future, which is pretty tough. And then sooner or later, it'll disappoint. And you'll say, does that mean all bets are off? Is this thing looking like a catastrophe? If it doesn't, well, you've got to stick with it, I would say, and buy some more. If you feel that the long term's still there, you've got to hold your nerve. That becomes harder. First of all, have the mentality as an investor rather than just trade. So if you're an investor, you need to be prepared for short-term losses as well as gains. That's the nature of equity markets. If psychologically you're not prepared for that, I wouldn't even go there. You just hold a fund. You've got to be still prepared for losses with that as well. But I think the psychology is more and more important. And I think some people aren't prepared for that, and it'll be hard to change. They get too worried. We also run a diverse book. If you're on smaller quoted companies, have the ability to disappoint massively. They can also bring great joy occasionally as well. But in terms of the potential for immediate downside, significance is greater than immediate massive upside unless they're being taken over. Be prepared for that, and therefore, I run a diverse book.
So if somebody's listening to this now thinking, it's just not for me, passive investing, the rise of passive investing, more and more popular, do you think that's having a negative impact on AIM shares because more and more people are gravitating towards that?
I think it's having an effect on probably the bigger end of the market more than the smaller end, because people are, as you say, gravitating to passives. Few people are really interested in what they've invested in, worryingly. As I said, they probably don't like to think they're holding tobacco, but if you're holding a FTSE 100 tracker fund, you're holding tobacco stocks. You're holding oil and gas companies. You're holding mining stocks, whether you like it or not. So yeah, I think it's an easy way of doing it. What I find is being abused is what was a fairly simple concept of creating an index, a fund around an index. It's now been an index of an index. You have passives investing in other passives, and it's just layer on top of layer. It's a crazy scenario. An index of an index in there as well. Seems ludicrous. So I think it's being abused. And yeah, it is affecting, I think, the market as a whole. AIM shares, there is a tax advantage for holding them directly in saving inheritance tax. So that has actually made people sort of return to investing basics, where you've got to hold the direct equities. So there's no benefit in holding an AIM fund for tax purposes. I would say that many people who want exposure to AIM, maybe more elderly in particular, and wants benefit from the tax, we're better holding the shares rather than investing in a fund, because that holds a lot of AIM shares. There are a lot of small cap funds that own a lot of AIM shares, but there's no inheritance tax benefit from holding that.
There's a lot of rumors around the AIM tax break again. Have you got any thoughts on that?
I think the bigger talk is probably around inheritance tax as a whole. Jeremy Hunt, Chancellor, committed to keep those in place until 2028 or whatever. So it's going to be nigh on 2 decades that you're going to have had IHT threshold at the same level, 325,000. However, people forget that they added a nil rate, a residential nil rate ban, which added another 175. So effectively, you've got 1 million outside your estate, but that's going to be fixed. So the IHT take has been going up and up. I think it's doubled over the last 10 years or so, the inheritance tax take. So that's putting pressure, but it's still a pinprick. It's less than 1%, or it's 0.7, I think, of the overall tax take. it's a tiny, I thought would be the easy win would be to lift the threshold again because it has remained fixed. People are saying remove it altogether, inheritance tax, but can the government afford to lose out on even, what is it, 7 and a bit billion a year? Still decent number, isn't it?
It is, yeah.
Do they want to lose out on that? So it's a difficult one. In terms of that related to AIM, I would say that the UK needs to be doing more to encourage innovation and growth. So the tax breaks should be enhanced rather than reduced. If they want companies to grow and us to develop more technology or life sciences, we need people to be encouraged to invest. So rates shouldn't be reduced.
We mentioned earlier 25% corporate tax rate. Ireland, for example, is 12%. Like you say, to encourage investors to invest directly in AIM, we've got the inheritance tax break. The government could introduce a tiered corporate tax rate for newly listed companies.
Yeah, it could do. Yeah, I agree. Thinking
over a 5-year period.
I think there needs to be more innovative thinking like that to encourage it.
Got to be an incentivization, hasn't there? Something to encourage them to take the.
You're right. Something has to be done because the market's dying on its knees, the UK market.
I would rather the government go down something like that than the government trying to direct people's personal pensions.
I know. Impose, say you've got to suddenly chuck a load of your money into some startup.
Yes.
We have seen how fraught, if you throw too much money in this area.
I'm worried how bad that is going to end up.
Well, we had that. We had free money. Too much free money was thrown at startups.
Yeah.
We've had a lot of free money for the last decade or so. We had EIS incentives. Suddenly you had people raising money in the VC space without enough decent companies to invest in. So you saw hugely inflated valuations of many businesses that, quite frankly, even an idiot could say that they weren't going to go anywhere, or they weren't worth the money that people were saying they might be worth. So yeah, I agree. It's a recipe for disaster. It will demand a lot of control anyway.
Yeah, the government deciding they're going to redirect people's pensions is concerns me.
Interesting. Yeah.
Are we an optimist or a pessimist? Are we bullish? Are we bearish?
Got to be an optimist in this game. Got to be an optimist in this game. Yeah, look, it's really tough managing our clients' expectations in this time.
Yeah.
And we keep banging the drum that things are cheap. They are cheap. There are good growth companies that are going cheap. I'm forever an optimist, but it is tough.
Yeah.
You know, it's a tough game, but forever an optimist, reasonably bullish on, I'm still bullish on the UK. I just think it needs to sharpen up. We need to be better at marketing as well. There's no doubt our friends across the water are great salespeople.
They are.
We need to be better salespeople. Get out there.
We need to promote UK PLC in a positive light. I don't think we've seen a positive message for quite some time now. The UK government, leadership, or anything. There's not been a positive sort of something that we can all get behind and say, wow,
But going back to the first point, PLCs themselves need to think more creatively in how they deploy capital for the greater return of their shares over the longer term. Over the longer term. I think this is a fundamental problem.
Yes. I have an idea, Chris. What do you think about, so this is live on the podcast. I'm just thinking, as a way of promoting UK small caps, UK business owners, successful CEOs, founder-led companies, should we invite them on the podcast and they can share their story, their company?
Yeah. I think it'd be interesting. I think some founder-led businesses, the journey has been interesting. They've gone through the listing, they've gone through, how has it been? Yeah. So maybe less about the companies, but more the whole journey, promotional journey, and what it's like for them being listed.
What it's like for them, and hopefully inspire some people to actually take the plunge, listening to people who have actually been there, done it, and they can share their experiences.
Because for a lot of them, it must have been a blooming nightmare. So it's worth I think it's worth a good initiative.
Yeah. So we can do our little bit. We can help. We can do our little bit.
Absolutely.
So any founder-led companies that have listed and would like to come on and have a chat on the Fundamental Asset podcast with myself and Chris, share your journey, inspire others, please reach out, info@thefundretirement.com, and we'd love to get you on.
We'll try and get it out there, get the message out there.
Yes, agreed. Thank you very much, Chris. See you next time,
Let's hope for better returns going forward and fewer takeovers of great British companies. We want them to go on to great things by themselves, not being swallowed up by some eager, cash-rich overseas buyer.
Agreed 100%. And don't forget, any founder-led companies that have listed on AIM or CEOs that have been in charge of a company on AIM for a period of time, please do get in touch, info@fundyourretirement.com. We'd love to have you on the show and we can have a great conversation about your journey and your experience, and you can tell your story. And Chris, we'll see you next time.
Thanks very much, Lee.
Well, that's it for today, and thank you for listening. If you enjoy this type of content, please subscribe and leave us a comment to let us know. We do also have many other investor-related podcasts and expert hosts on the Fund Retirement Podcast Network, so please feel free to check them out. We also have 2 new hosts and a new show coming very soon, which we are very excited about, so please keep an eye out for the first episode, which will be published very soon. Thanks for listening, and I hope you have a great week.